I remain a long-term gold bull, meaning that if you look at the government spending and what's going on in the world and the fiat currencies and the dollar slowly being devalued and probably slowly de-dollarization as well, it makes sense to buy gold. For me, though, I want to make sure I get it as close to the lows on this pullback as possible. And for me, that's 3,500. A lot of your listeners bought gold like I did years ago because it's a safe haven. It's a way to protect ourselves against fiat currencies and lots of other shocks.
I am buying more physical gold right now. I'm willing to pay these prices, believing that gold is going to see more than likely 6,000 this year, if not higher.
What if I told you gold could hit $6,000 this year, but first crash to $3,500? That's exactly what top analysts like Gareth Soloway and Todd Horwitz are warning right now. Gold is no longer just a safe haven. It's turning into a momentum-driven market, and that changes everything. So the big question is, are we about to see a massive breakout or a brutal shakeout first? Let's break it down.
Before we get to the chart, one of the things I want to just mention is that we've seen this change in gold ever since that rally that basically started at the beginning of the year, the final, what we would call a blow off top. People started to jump into gold, not because it was a defensive play, but more because it was a momentum play. And anytime you have an asset that is more of a safe haven asset, where it starts to become a momentum play, it tells you that the structure or the reason it goes up or down is now changing. And ultimately, it has to flush down enough until it washes out those weak hands that bought it for the wrong reason. For example, a lot of your listeners bought gold like I did years ago because it's a safe haven. It's a way to protect ourselves against fiat currencies and lots of other shocks. So if we look at the chart, we can see here that we had the big blow off top right here, right? Parabolic move from about the 4,300 level all the way to 5,600. We then got the sharp correction and this sideways inside bar, another correction, and now again a bounce, and we're starting to come in again. And really what we're seeing now is high, lower high, low, lower, low, right? So essentially we've changed from an uptrend in the near term to a downtrend. And that really has me more skeptical in the near term that gold's going to turn back up and make new all-time highs. Instead, the chart's telling me that we're likely coming down to this 4,300 level, maybe a small bounce, then we'll break down to 3,900 here. Now, again, will that be the bottom in gold or not? That's a good question. I do think that there's potential for a washout later this year back to about the 3,500 level. And at that point, that's where at least I've already isolated down where I am going to be buying long-term positions, right? So again, I remain a long-term gold bull, meaning that if you look at the government spending and what's going on in the world and the fiat currencies and the dollar slowly being devalued and probably slowly de-dollarization as well, it makes sense to buy gold. For me, though, I want to make sure I get it as close to the lows on this pullback as possible. And for me, that's 3,500. A lot of people like myself were buying gold years ago and even more recently. Those reasons are still intact, right? Again, you look at all the issues that are going on with government spending, and we're talking globally here, the debt loads that are being put on so many countries, so many citizens. So I think the underlying factors are there. It's more that first thing you mentioned, which is that you have this period where investors, generally the investors that buy momentum, they don't have the staying power to stick around in a trade when it gets boring or if it slowly drifts lower. And when they start to unload, it then pushes that sell pressure even more. Now, granted, we could still say you have sovereign nations still buying, Federal Reserve banks are still buying gold. That's absolutely true, but there's still a lot of weak hands that are in gold that could cause it to kind of correct back down. And I would even say that we have to remember that when things get bad, meaning like COVID, remember 2020 of March, even though COVID was the obvious reason why gold should spike, when fear absolutely hit and the panic was in the markets, even gold sold off. And so you might see some sort of event where the stock market really gets scared, and that could be the final drive from 3,900 down to 3,500. And then that's where you start to see the reversion trade and it start to trade back up.
We're really just in a pattern of consolidation. Markets have their low is around 4,500, their highs are around 4,800. And we've been churning in that range for a while. I fully expect this breakout to come to the upside. When is that going to be? I can't answer, but certainly I would be the long. And if I were to advise anybody, which again, that's not really what I'm supposed to do, but I am buying more physical gold right now. I'm willing to pay these prices, believing that gold is going to see more than likely 6,000 this year, if not higher. I think paper is to me, paper is worth what it's written on, worthless, right? And it's the stuff you go when you go to the bathroom. That's what that paper is worth. But from a trading standpoint, it's fine. Okay, paper to trade paper, I trade paper all the time. But if I want to own it, if it's an asset that I want to hold for a long term, I don't want to own paper gold. I don't want to own miners. I don't want to own any of that crap because I don't think there's enough gold in the world to cover the amount of paper that's written on it. Okay.
Right.
But again, so you have to decide, are you investing and you're going to put it away or are you trading it? When I'm trading it, I'm trading paper. I'm not trading silver, physical back and forth. It's too hard. So paper is the best mean for a trading vehicle. That's what I will use as a trader. But as an investor, I'm buying physical and I'm storing it.
Right now, the long-term case for gold is still incredibly strong. We're talking about massive global debt, endless money printing, currency devaluation, and rising de-dollarization. These are the exact conditions where gold historically thrives. In fact, data from the World Gold Council shows something critical. Physical demand barely increased, but value demand surged nearly 74%. That means gold is no longer just jewelry. It's becoming a financial weapon against uncertainty. But here's where things get interesting. According to Gareth Soloway, gold's recent rally has changed character. It went from a safe haven investment to a momentum trade. And when that happens, markets usually do one thing. They flush out weak hands. Technically, gold is now showing lower highs and lower lows, signaling short-term weakness. His targets? A potential drop to $3,900. Even $3,500 before the next major rally begins. Why? Because momentum traders don't stick around. When price stalls or drops, they panic, and that creates cascading selling pressure. We've seen this before. Even during the 2020 crisis, when gold should have surged, it actually dropped first due to panic selling. Now on the flip side, Todd Horwitz sees something very different. He believes this is not weakness, but consolidation before a breakout. Gold has been ranging, building energy, and when it breaks, it could explode towards $6,000 or higher. So we have two views. Short-term pain, long-term massive upside. And both can be true. Now let's talk about positioning. One key theme from both experts. Physical gold versus paper gold. Paper gold is great for trading. But for long-term protection, many investors are choosing physical ownership due to concerns about how much paper gold actually exists versus real supply. Now shifting to silver. Silver is even more volatile and more explosive. After hitting $120, it crashed hard and is now forming the same bearish pattern. Lower highs, lower lows. Soloway warns silver could drop to $50, even $40 in a worst-case washout. But here's the twist. Long-term, silver may actually outperform gold. Gold upside, 25% silver upside, 40 to 50%. Why? Because silver has industrial demand plus supply deficits, making it more sensitive to economic shifts. Finally, one critical warning. The biggest mistake investors make? Over-leveraging. Leverage amplifies gains, but it destroys you during downturns. And in volatile markets like gold and silver, that's a recipe for panic selling at the worst possible time.
I think, again, we just have to be a little bit more careful with silver as it's obviously somewhat more industrial. And so it has more of a sway based on how the economy is doing. But what we can see is the same thing happen, that incredible move to $120 per ounce on silver, the massive collapse down to 64, a bounce, then another lower low, another lower high. And you can see again, high, lower, lower, high, lower, high, low, lower, low. So it implies that silver is likely going to come down, small bounce, and go even lower. And I'm still looking for sub $50 silver. And I know people don't want to hear that, but you can kind of make a case for it, right? I mean, here we are in an economy that this oil trade might start slowing the U.S. economy and the global economy. And then also if silver and gold and the metals are going to see a decline from kind of flushing out the weak hands, that combination could easily push us below that $50 per ounce level. And I think that's kind of where I'm eyeing here. On a technical basis, really this zone here, which was that final, notice how we kind of did this little bit of a cup and handle pattern and then broke out. And this would be a resumption or a retrace into that same sort of zone, which should act as technical support around $50. And I know it's amazing because, just earlier this year, we were at 120 on silver, but this is historically, silver is very, very volatile like this. When we got above $100 an ounce in silver, that was kind of where I was like, okay, this is getting a little ridiculous. It should pull back. And it still went to 120, right? So, what we know is human nature is to greed or FOMO in at the highs, and then at the lows, that massive panic. So I do think, there's always a chance it goes lower. You could be talking $40 or something in that range, but we have to keep in mind that there is still a deficit in many situations with silver. You still have to mine it, which costs money. And so as costs go up, at a certain point, it doesn't make sense as much. And granted, silver is a lot of that offshoot of gold mining. But for the most part, I would say that sub $50 to $40, that would be the overshoot, would be down to 40. If you think about it, from 100 to 120 was a 20% overshoot. From 50 to 40 would be a 20% undershoot of that level. Either way, for me as a technician, looking at the long-term fundamental aspect, it's kind of like, okay, once we get down below 50, that's where I just start to slowly accumulate those longer term positions with my main thesis of where things are going being intact.
I think that silver will outperform gold as we go forward. Okay. I think gold, let's say gold has a chance, in my opinion, from where we are right now, to go up about 25 or 30%. I think silver's got a chance to go up 40 to 50%. So I think silver is going to outperform. And of course, for many people and many investors, it's a lot more palatable because of the price, right?
Right.
You want to lay out a big number, So again, either way, but I would have some coverage to gold, silver, and platinum. If I were to break it down and I had X amount of dollars, I'd buy 50% silver, 30% gold, 20% platinum. Well, again, you do get some of the players, that are buying silver, but they're selling paper because, again, paper is worthless, and they can control the paper market a lot easier than they can control the physical market.
Right.
So you can force people, because more people are going to participate in the world of paper because they can use leverage, they can use margin, they don't have to take delivery, they don't have to pay for it up front. There's a whole bunch of reasons why. So it's a lot easier to force pressure on people using paper, especially if you hold the physical metal, because if I hold the physical metal and I own enough of it and I want to push prices down, I can force paper down, which is then going to force physical down. Well, the biggest mistake anybody ever makes in any trade or market is they get too big, they over leverage themselves. Okay.
Right.
So when you over leverage yourself, it magnifies the move for you or against you. And again, for you, nobody ever complains when the market's going in your favor, right?
Right.
But when it goes against you, it forces people to panic, especially those who have not seen these market cycles before. It forces people to panic. So you need to invest in whatever you're investing in, whether it be gold, silver, Bitcoin, whatever you invest in, that has to be money that you're not going to need tomorrow. You're not going to need to pay it for the mortgage or the car payment or the rent, whatever it is. That money has to be met on something that you can afford to hold on to and close your eyes. And that's, of course, one of the big problems in markets today. Everybody's got an iPhone or an Android phone, and they're checking their 401k every 10 minutes. Well, you're not getting out, so why check it?
Right.
But that is the flow of information today forces people to make a lot of dumb decisions. And of course, they have the ability, especially in the futures market, to get too much leverage. And of course, like I said, leverage is unbelievable when you're right. But when you're wrong, leverage is very painful.
So here's the bottom line. Gold and silver are still in a long-term bull market, but the path forward could be extremely volatile. We could see a deep correction first, before the next historic rally begins. The real question is, are you prepared for the shakeout, or only the breakout? Let me know your view in the comments, correction first or straight to new highs. And if you found this valuable, hit like, subscribe, and stay ahead of the market.